thinking about buying a house, or you'd like to in the future, but you're nervous about your credit score. Do you even know what your credit score is? Hey, I'm Rachel Kilmer with ReeceNichols in the Kansas City area, and this is Aubrey Washington of Flat Branch Home Loans, and we are here to give you the scoop on all things Kansas City. Specifically today, we are going to teach you everything you need to know about your credit score and how it impacts buying a house, and maybe how to fix it. Let's jump right in. Okay, Aubrey, one of the first questions that people ask me when they're thinking about buying a house is, do they have a good enough credit score? What are the minimum credit scores to buy? What do people need to know? And where do they even check their credit if they don't know what their credit score is?
Yeah. That's actually a very common question that we get. And so scores can range, obviously quite a bit, but the minimum credit score for any government loan is 580. When I say government, I mean FHA, VA, and USDA loans. And then conventional, the minimum is 620 credit score.
So that's definitely lower than I think a lot of people think. I
Right.
think a lot of people think they have to have this perfect, amazing credit score
Correct.
to buy a house. Mm-hmm. So this is probably a dumb question, but I truly don't even know the answer to this. How are credit scores made up? What are they made up of? How are they compiled? How do they assign you a credit score? Like, what's the breakdown of it?
Right. So a credit score is comprised of, how well do you make how on time are your payments? Are your payments timely? They look at they factor in the length of credit history, the a type of accounts you have. So if you have revolving credit, actually will help your credit score. Mm-hmm. And that's one thing we talk to our clients about. If you have just installment loans or maybe a prior mortgage, but you don't have any revolving credit, we need to get you some credit cards. I know Dave Ramsey says, stay away from credit cards. We love Dave Ramsey, but sometimes his advice doesn't apply in the real world really well. And so by having revolving credit cards, what they're looking at is the utilization. And so if you have a $1,000 credit limit, but you have a $200 credit balance, then you only have 20% utilization. That will take your score a little bit higher. Likewise, if you have a $1,000 limit and you have a $1,000 balance, you're going to see a dip in your credit scores. So they're really looking at utilization. The reason that doesn't impact on a car loan or installment loan is because that's just a set monthly minimum payment that no matter how much you have access to, you still have to make the minimum payments. Mm-hmm. Utilization is what they're looking at when it comes to credit cards. So type of credit, length of credit history, payments, timely. And then inquiries actually make a portion of that too, which is another common question we get is like, I don't want to have my credit pulled. And that actually only makes up about 3% of your score makeup. So maybe you're looking somewhere between 3 and 10 points. It's actually a lot less than people expect when it comes to an inquiry.
Yeah, that is something that I hear a lot of people say is like, I want to know if I qualify or how to qualify, but I'm scared because I don't want the credit hit. So it's good to know it's really just a minimal impact. And then they can look at more than one, shop around with lenders, can't they?
So then there's with a like trade inquiry window. So two things when it comes to inquiries. Number one is there's actually a way we can do your credit. We can review your credit without having an official inquiry. Mm-hmm. So it's essentially as if you pulled your own credit. It's called a soft trade or soft pull. It gives us 2 of the 3 credit scores that you have and allows us to make a loan decision and determination and really give you a sound plan to move forward with purchasing without having any negative impact on your credit. So it says literally the inquiry won't appear anywhere, and it's a great tool. So, and that's really something when you look at, maybe somebody's timeline is a lot longer. They think I'm going to buy in the next 12 months. Well, we don't want to do an official credit inquiry quite yet because those are actually only good for 120 days, but we can do a soft pull and it gives us a whole game plan.
Yeah, makes sense. So where should people, if they want to monitor their credit score and like they're preparing to buy a house in the next couple of years, they're trying to make sure they're at a certain number, what's the best place for people to monitor their credit score and check it? And I know like sometimes they think it's one thing and then they come to you and it's something else. So how does that work?
Yeah. So what I sell, everybody can get 1 copy of their own credit report free from each bureau once a year, and that's on annualcreditreport.com. So you get 1 from TransUnion, 1 from Equifax, 1 from Experian, and that actually will give you the true and actual credit scores. And that's great to monitor the content too. Mm-hmm. Those are free. But then many banks or credit cards, they offer free credit monitoring through that service. So I would definitely say if your credit card or bank offers those services, sign up for that. It's typically free. The one that we see the most is Credit Karma. People use that a lot, and people get very disappointed because they'll think their credit score is one thing, and then they come to us and it's a totally different score, maybe 100-point difference.
Wow.
And so, it can be very frustrating when you've been monitoring, thinking you're doing all the right things to get yourself poised to buy this house, and now you've been told you're a 585. So, anywho, the point of Credit Karma to me would be you can still get a good gauge of the content that's on the report, but don't expect it to be accurate when it comes to scores. They're totally different algorithms, and so if you can, I would do a bank or a credit card monitoring service.
And what was the name of the website where you can get it once a year?
It's annualcreditreport.com. Not freecreditreport.com. That actually is a paid one. But annualcreditreport.com.
Okay, perfect. I'm asking because I need to do that because I don't do that. So
Yeah.
So if your score isn't what you want it to be, whether for whatever reason, but particularly if you're wanting to buy a house in the near future, your score is not there yet. What are some generalizations that people often do to improve their score? What are common mistakes that people do when they think they're doing the right thing and then it actually can hurt them? And then what are some of the best things that most people do to improve their score?
Okay, so what I would say is one of the best ways is obviously first thing first is to look and see what are my utilization. So on your credit cards, if you have 30% or more of your credit balances utilized, then I would get those paid down to 10%. That's going to give you 10% or less will be your ideal credit scoring. Or ideal for credit scoring purposes. The other thing you can do is do what I call piggybacking off someone else's credit. So say you have a friend or just probably a family member that is willing to add you as an authorized user, say on their Chase card that they've had, say maybe since 2017. And now all of a sudden, once they add you as an authorized user, I'd like to remind people that, so to the person that's allowing you to piggyback off their credit, there's no negative repercussions for them. They don't have to actually give you a credit card to use. They just have to call Chase and ask, or whatever bank, and have you added to their credit card. Within 30 days, it will then report to your report as if you've had that credit card account that whole time.
Oh.
So it can, I've seen 100-point payment swing, 100 points credit swings in 60 days for people. It can make a big difference. So if you're doing something like that, you want to make sure that it's, don't ask somebody that carries super high credit limits, or that maybe they have a high credit limit, but you don't want to have high balances on your report. So let's see what else. Other strategies on.
Is it always smart to pay off cards? Like, can it ever hurt you to pay off a card right before?
So no, you can pay off. I would say definitely, that's a good point. Don't close any accounts. Especially you want to be mindful of closing. If you ever closed an account, you want to keep the ones you've had the longest open because that actually gives you the depth of credit history that's going to help your score the most. And as far as paying things off, what we see often is that people, immediately before they come to us, they assume, I need to pay off these collections or pay off any past due accounts. So bring your accounts current if they're active accounts. That's always great. But if you pay off an old or aged collection, that actually can sometimes hurt your credit score, believe it or not. So say you have a dormant credit card that you haven't paid, that maybe charged off, or it was a collection back from 2019. They no longer are, it's not actively reporting. It has a last activity date of, say, 2019. If you go and pay that account, now all of a sudden you have a new last activity date of 2024, and now that's actually probably going to drop your score because it's re-aged that account. It's been dormant for 5 years. Also charged off, as far as charged off accounts, those typically are not something to be concerned with anymore because the creditor's no longer collecting on that. So we actually don't have to consider that in your qualification as far as your debt ratio. And then medical collections, that's something we completely disregard as well.
Really? That's interesting.
Yeah.
I think something else that a lot of people think is that they have to pay everything off and be completely debt free before they buy a house. That's a common thing. And sometimes it's not hurting you to carry a little bit of debt, and you're actually better off having that cash on hand to use for your real estate transaction.
Yeah, especially these days.
Yeah, when it's competitive. So I think the biggest thing is to get with a lender early before you take any big steps.
So it's kind of like, I would say, like going to the doctor. You don't, of course, we're all on WebMD first. We're trying to self-diagnose, but ultimately just, the lender is your doctor. They can help guide you through that process and tell you what you do and don't need to do, because you don't want to waste your money paying something off you don't need to, and also just wasting the time, and potentially the credit score could go down too.
Yeah, for sure. So I think all of this is like great, kind of abstract, but what really helps me is to see like a real life example of someone that has improved their credit score or how this has impacted their home buying process. Do you have any recent examples?
So I was thinking about one. So we had a client that they did qualify, so their credit score was good enough to be qualified, but we kind of talked through okay, what if we ran a credit simulator, which is a super cool tool. So it allows us to go into each credit bureau and simulate, what if they pay this down? What if they do this? And I was able to do a simulator. So for about $4,000, this client paid down on some credit cards, so it improved her utilization. And she got it was about 0.5%, so 0.625 better in interest rate.
Wow.
Which, depending on your loan size, that can actually be a pretty significant amount in payment. And it actually still ended up helping her anyway, because of course those were credit cards she was paying, so it improved her ability to qualify for more as well. So not only did she get a better rate, she could qualify for more house, so it's great. And it doesn't take long. I mean, we're talking 30 days.
Yeah. Which the qualify for more is the debt to income ratio, which is a factor in this as well. So explain what debt to income ratio is.
Okay. So what most lenders, what we're looking for, I mean, there's always a calculation, and then I'll talk about ideal calculations, but we're looking at your housing to income ratio, and then your total income, total debt to ratio. And so what your housing to ratio is we're going to look at your proposed new house payment with taxes, with homeowners insurance, and with any applicable HOA dues. And we're taking that and dividing that into your income. Now, from a lender stance, we go off gross income. So we're not looking at net income. So it's very common you can qualify for a lot more payment than you're even comfortable spending, because we're looking at gross pay, not take-home pay. And I will say that, you've got cell phones and streaming services and DoorDash and all the things that, make life, life. So, but your front-end ratio is what we call it. That's your housing in relation to your total gross income. Then we look at your total debt ratio, which is your new house payment and any applicable HOA. And then with added to any other minimum credit cards, student loans, car payments, anything like that. And then we're calculating what we call a back-end ratio. And ideally, the maximum ratios do vary between lenders. But ideally, what most lenders are looking for is that you're somewhere on your house payment about no more than 33 to 35% of your gross monthly income is for housing. And then the back end would be, so all of debts combined would something about 45 to 46%. You can exceed those for sure, but it's case by case.
So roughly speaking, if you make $10,000 a month, your all-in debt needs to be about $4,500 or less, and your house payment needs to be about $3,500 or less.
Yep.
Okay, makes sense. So all of this plays a role when you're trying to get approved for a loan. Your credit score, your debt to income ratio, all kinds of things. And the best thing you can do is just get with a lender really early on. Even if you think you're not ready to buy for a year or even 2 years, it doesn't hurt to have the conversation, do the soft credit pull, and put together a plan to do all the things that you need to do in the meantime to improve your score, so you're in the best position to buy when the time arrives.
Right.
So Aubrey, thank you for being here today. Guys, thanks for watching. I'll see you next time here on YouTube, where I'm giving you the scoop on all things Kansas City. Bye.
See ya.